I have to start with emphasizing that I am not deep at all. In addition, I have no result on neural networks. So this machine learning is a different part of the theory. The aim in this project was to create a purely empirical growth optimal portfolio strategy where we have three components. One is that it is a multi-asset and multi-period scheme, which means that we have a discrete time setup, and in each at the beginning of each trading period, let's say trading day, we can rebalance our wealth among the assets without any restriction, and we don't assume any model on the market process. We just learn the good strategy out of the past data using some concepts of non-parametric statistics and machine learning. With the non-parametric statistics, we create a pool of strategies, a reservoir, and using machine learning concepts, we aggregate this strategy in order to get asymptotically growth optimal portfolio strategy. The setup is very simple. We have T asset and discrete time model, and SNJ denotes the price of asset J at the end of trading day N. Just for the sake of normalization, the initial price is 0. We introduce the relative price, the ratio of the consecutive prices for asset J. So if the price increases, then Xij is slightly larger than 1, otherwise smaller than 1. And it means that if at the beginning of trading day I, we invest $1 into asset J, then at the end of the day, we see Xij dollars. So the vector of relative price is called return vector for day I. Just to introduce this concept of portfolio selection, I start with the constantly rebalanced portfolio where the way of rebalancing does not depend on time. So the portfolio is a probability vector, vector of non-negative numbers summing to 1, and BJ tells that this fraction of the wealth is invested into asset J at the beginning of the trading day. And in this starting scheme, we assume that the way of rebalancing does not depend on the time. The evolution is simple. If S0 is the initial capital, then S0 times BJ is invested into asset J. $1 investment results in X1J. So altogether, the amount of money at the end of the first trading day is the product of the initial capital and the inner product of portfolio vector and the first return vector. We repeat it at the end of second day. We have a product, and by induction, Sn, the amount of money what we have at the end of day N, is the product of the initial capital and the product of the inner product of portfolio vectors and return vectors. And it looks simple. So if somebody just passing the elementary exam on elementary introductory probability theory, one may argue as follows. So Sn is a random variable. We would like to have Sn as large as possible, and this Sn depends on the portfolio vector. So it's a random variable, this product, and maybe we argue as follows. So this random variable is around its expectation. So let's look at the expectation of this product and maximize the expectation. And it is completely misleading argument because the probability theory is not on the product of random variables, it is on the sum or on the average of random variables. So it is reasonable to introduce the growth rate for these wells, which is already an average. So as soon as the return vectors are independent, identically distributed, random variables, then this average goes to the expectation, the expected log return. So it's an obvious consequence is that as soon as the market process is memoryless, the good choice of the portfolio vector is as follows. For any portfolio vector, we have to calculate the expected log return and search for the portfolio vector B, which maximizes this expectation. This is for the memoryless market process. However, if the market process is not memoryless, it has a dependence, then we can do much, much better than this log optimum portfolio vector. So let's turn to the general case when the portfolio vector, the choice of portfolio vector depends on the past data. For the first day, we have no past, so for the first day, the portfolio vector is arbitrary, and the result is as before. For the second day, the portfolio vector may depend on the past, it is the first return vector, and in the case day n, for the step I, the portfolio vector is an I-1 vector variable function, and the growth rate is an average of this complicated logarithm. And the question is how these functions of I-1 vector variable has to be chosen such that for long run this W and B is large as possible. It looks very strange and very complicated how to choose in a time-dependent way these functions. So in general setup, we assume that the sequence of return vectors is an arbitrary vector value stochastic process. And in this case, the log optimality is a generalization of the previous log optimum business, such that we choose an arbitrary function B of n-1 vector variable, evaluate the conditional expectation of this log return given the past data, and search for this function which maximizes this conditional expectation. So previously we had just the expectation. In case of memoryless process, we get back the previous concept of log optimality. And the optimality is formulated as follows. Let Sn star be the wells for applying the log optimum portfolio B star, and Sn the result for an arbitrary other. Compare the two growth rate. This is for the arbitrary strategy, And this is for the log optimum strategy. And this optimality of Paul Algut and Tom Cover says that along almost all realization, the arbitrary strategy cannot outperform the log optimum one. So it is not just an optimality or in terms of expected log utility. It is a very strong statement. With probability 1 along all realization of the market process, the log optimum portfolio will win. Moreover, if the actual market process is stationary and ergodic, then we can calculate, at least in principle, this best growth rate, and this W star is the maximum growth rate of any portfolio strategy. So it's an extremely strong statement. And here's the proof. As before, this red average is the average of log return for an arbitrary strategy. And I make a telescope at the red average of conditional expectation and subtract it. Why do this telescope? Because the blue average is an average of martingale differences. And from the kindergarten, you know that under very mild moment condition, the average of martingale differences goes to 0 with probability 1. So the two red expressions are almost the same. Let's make the same telescope for the log optimum portfolio. We have to prove that this average growth rate for long run is smaller than the average growth rate of the log optimum portfolio. Equivalently, almost equivalently, it means that this red average is smaller than or equal to this red average downstairs for large n. But it is true for all n, because for all I, the I term here is smaller than or equal to the I term here because of the definition of the log optimality. And the proof is finished. So it's simple. Well, their proof is a bit more complicated, but the scheme is clear, and just the law of large numbers for martingale differences. The question is the following. Whether or not we can, well, here is the definition of universal consistency. In general, we know that the limb soup of the average growth rate of any strategy is less than or equal to W star almost surely, with no regard how we choose the strategy. The question is whether or not we can learn such universally consistent strategy over a huge class of stationary ergodic processes. We don't assume any parametric model for the process, and the answer is yes. And the main aim of my talk is to present the idea how to can come up with such strategy. It is a definition of the log optimality, and for the sake of simplicity, choose a window size k, and instead of taking into account all past data, we just take into account the k-length past of the near past. K-length, yeah. If k is 1, then we take into account what happened yesterday. And Similarly, we choose we define the BK, which maximizes this conditional expectation with k-length past data. Because of stationarity, it is easy to check that it means that for the conditional expectation, we have to choose the portfolio vector with this, in this way. Any conditional expectation can be considered as a regression function. Here, the regression function is indexed by the portfolio vector B, and it was the point where I became interested, asking what happens if instead of the true regression function, I estimate the regression function and maximize the regression function estimate instead of the true regression function. See, here is a short summary of the basic principles of regression function estimation. We have two random objects, an observation vector and a real y, and we would like to estimate the regression function, the conditional expectation of y given x. And maybe the most simple and most popular estimate is the regression function estimate, which says the follows. If at a point x we would like to estimate the regression function, then look for similarities in x. We search for x sub i's, which are close to x, which means that the distance is less than r, and take the average of the corresponding y's. It's a very obvious local averaging estimate, and in this way we first estimate the regression function. If you would like to read more, including the neural networks, it was not my chapter, from this book. So the correspondence is easy. The observation vector is the k-length past of the current time. The y is the log return, and the regression function estimate will be denoted by m sub b. The next step is a regression function estimate, but instead of one regression function estimate, we create a pool, a double array of regression function estimates. A double array where one index is the window size k, and the other index is denoted by L, and k and L will result in a radius, RKL, and assume that for each fixed k, the radius goes to 0. And we do the following. Assume, so we have, we are at the beginning of day n, and we see the past segment from n minus k to n minus 1, and search for similarities in the past. Similarity means that the distance of these two segments is less than r. As soon as we find such I, then we store this I instance into this set J sub n. And take the local averages of the corresponding log returns. It is the kernel estimate of the conditional expectation. So we have a pool of estimates, and the portfolio selection will be such that for each fixed k and L, we maximize these estimates, maximize in B. So in this way, these estimates depends on B just in the numerator. So this is equivalent to maximizing the numerator without normalizing. If there are no matches, if the set Gn is empty, then the portfolio vector is just the uniform portfolio. Equivalently says the following: we have a subsequence of return vectors after the matches, and along these subsequences, we design a portfolio vector which results in the highest amount of wealth. Okay. So we have a double array, double infinite array of strategies. Let's call elementary portfolio or experts. And obviously, there's a hard question how to choose K and L. If K is small, then maybe we don't utilize the dependence within the market process. If the R is large, then the estimate is not local. So the bias for the regression estimate is large. The other way around, for large K and small r, maybe we have no matches at all. In the statistics and related areas, the traditional idea is to find K and L in a way, somehow match the data to K and L, or other way around, find a data-dependent window size and radius. The machine learning has a completely new principle. It says that we have to run these strategies and combine these strategies depending on the past performances of the strategies. The most obvious combination, it is essentially not a combination, it's a data-dependent choice of K and radius, is that, okay, all the experts are sitting in this room, and in the morning of day n, I look at the pocket of everybody here and look at the portfolio vector, what he or she suggests. And I see that András has the full pocket of money, so I trust him, and I see his portfolio vector for today, and I apply his portfolio vector for today. It is the follow the leader. For the follow the leader, we have no proof of consistency. Essentially, this part of machine learning, the idea comes from this book, Niccolo Cesabianchi and Gábor Lugosi. I have many good and famous students. Gábor is in Barcelona already since '96. And it is a very nice book. The prediction part is, how much time I have? Because only.
Maybe three, okay.
No, then I skip this. Okay. What is the suggestion? Choose an arbitrary probability distribution Q and introduce a weight. And with this weight, we take the convex linear combination of the portfolio vector. The general aggregation is as follows. We introduce a learning parameter eta, which is positive, and with this eta, previous sheet, eta was 1. and take the convex linear combination of this portfolio vector. We have consistency proof for eta less than or equal to 1, but the experiments are much better for eta larger than 1, but we have no proof for the consistency. If anybody is interested in the problem, then let me know. For large eta, this aggregation means approximates the follow the leader. And the theorem is as follows. As soon as the expected logarithm has finite expectation, otherwise the market process is arbitrary stationary ergodic process, then the growth rate of this strategy, aggregated strategy, goes to W star almost surely. The main message: instead of choosing K and radius in a smart way, aggregate the strategy, take into account any strategy, maybe with a small weight, but we have to aggregate the strategy and not the window sizes. And okay. Another proof, because again, it's simple. It is the growth rate. From the optimality, we know that for any strategy, the growth rate, the limb sup of the growth rate is at most W star almost surely. We have to prove the other way around. It's easy to see that the amount of money can be calculated in a simple way. It's just 2 lines. And then we have to have lower bounds for the actual growth rate. This is the amount of money what we have at the end of day n. And just simply a sum of non-negative terms is lower bounded by the supremum of the terms. Exchange the supremum and the logarithm, and we go with 1 over n into the brackets. What does it say? Our dream, our target for the future would be to achieve the best possible growth rate. Best possible among the window size and radius. It says that the actual growth rate is at least equal to the supremum, because Q is a probability distribution. It is a negative correction term, but small. It is called in the Cesa-Bianchi-Lugosi book as a regret bound. Here there is no condition on the process, no condition on the strategy, so you can come up with any strategy, you have the same regret bound. And it is important because then we can use it without splitting into training and testing. In a sequential way, we can prove optimality. So from the previous page, we have this inequality. Do it. Okay. So we have that for infinite data set, infinite data, our growth rate is larger than or equal to the best possible asymptotic growth rate of the expert. And we can, it's an additional half page, that for infinite data, the window size can be large and the radius can be small. So the supremum is essentially a double limit, and it is equal to W star. Simple strategy, simple mathematics, and growth optimality universally. If you will have questions on the experiments, then I can continue it.